Are you looking to invest in real estate but don't have the funds to buy an entire property? Fractional ownership has been an option for those who want to get into property without breaking the bank. In this video, we're going to have a chat about fractional ownership and why I actually think it's a bit of a red flag when it comes to investing. So what exactly is fractional investing? If you haven't heard, there's a lot of companies that have popped up in recent years. Fractional investing is essentially having a portion of a property. If a property is made up of 100 bricks and you buy 10 of those bricks for $10,000, essentially the property is worth $100,000 nominally. So you own 10% of that property. The first problem I have with fractional investing is that their secondary market is very weak in these circumstances. There's not going to be a large pool of other people who want to own 10 bricks in a property or 10% of a home. Now, for a long time, Australia has had REITs or real estate investment trusts, where you can buy into a large pool of property assets. Again, the demand for a REIT or REIT is dependent on that secondary market. So you might buy shares in that REIT, but you need other people who want to buy your shares off you when you want to exit that asset. Almost everyone is probably going to own a portion of REITs because we all have super here in Australia. And super generally is invested in ETFs and REITs on Australian Stock Exchange. So I don't mind the idea of fractional investing. You're able to use your money and put it into a property by owning a small percentage of it based on the capital you can put in. But what are my 3 key concerns when it comes to fractional investing? The first key concern for me is the way leverage is used in these deals. Because you're only putting in 10% or 20% of that property, or even less in most circumstances when you're getting into fractional investing, you're not able to use leverage to your own advantage. Leverage to me is one of those, I don't know how many wonders there are in the world anymore. It's one of those wonders. It could be the 50th wonder at this point of the world, but leverage to me is one of those wonders that allows you to grow a property portfolio and create changes in your life. I've seen it in reality in the way we built our property portfolio. We invested a small sum of money and leveraged by taking on debt. And as that asset grew, it grew on the gross number. For example, you could buy $1 million home, and if it goes up 10%, you're making $100,000 in 1 year. Say you put a 10% deposit down on that property, you've got $100,000 in the deal, $900K of debt, and you've made an additional $100,000. Whereas if you put that $100,000 into fractional investing, you'd need that to double in value for you to get the same return. So you don't necessarily get access and the ability to use leverage to your own advantage. It's to the advantage of the people who control the REIT or the fractional investing fund. This leads me into my next point, which comes to the lack of control. So when it comes to investing into these types of properties, you don't actually have much control when it comes to the way your cash is used, how you can exit that deal, and what you could actually do to the property. You're not in control of the asset, the underlying asset that's in play. So say you were, buying a home using a fractional investing model, you don't generally get to control what happens to that home. So you might want to do a subdivision, you might want to renovate it, you might want to, change it in some way. But if you're only fractionally investing in this property, then generally you're not going to be able to have the control to make the decision to make these changes. Now, Emily and I have made a lot of money in actually renovating our properties. Yes, we've bought in markets that have grown as well, but one of our ways to fast track our journey was to manufacture value on the deals. And the way we needed to do this was to control the asset so we could actually do these renovations. So without that control, you can't really make changes to the property to fast track your wealth journey. Essentially, you'll be handing that control over to someone else if they are doing a project on the property and you're reliant on them delivering on the project rather than you having the control. And my third key point to round this out was the lack of liquidity in these situations. So if you're doing a brick by brick buy where you buy 10%, then you need to find someone else to buy your portion if you want to exit. Or you need the property to be sold and completed if it's under renovations or if it's a new build. Now, I don't believe fractional investing is all bad. I definitely think there's options to have it in a diversified property portfolio, but for me, I haven't really needed to diversify in that way. I've got our superannuation, which invests into ETFs and different funds, and we've got our personal wealth, which is largely invested in property by manufacturing value and holding assets for the long term. Now, this might be a great option for some people. Fractional investing might help people dip their toe in the water, get an understanding of what property deals might might look like, be able to have and see what the cash flow and P&L and balance sheet looks like for a property deal. But for me, the positives don't necessarily outweigh the negatives on a personal note when it comes to the lack of control, the lack of liquidity, and the lack of leverage in these scenarios. So I'd love to hear from you in the comments down below. What do you think of fractional investing and diversifying your portfolio through this method? There was a lot of hype about this in the last few years, and we're seeing more people try to get a slice of the property pie. Now, if you have super or a self-managed super fund, you should check this video out as to my thoughts on why SMSFs might be a trap. Thanks for sticking around. I'll see you in the next one. Peace.